My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Charlie Morris, who knows a little bit about being a multi-asset investor. We'll talk about that as well as what he does with ByteTree. But Charlie, introduce yourself to the audience. Who are you? What's your background? How'd you get involved, interested in financial markets, in gold and Bitcoin, and where are you located?
So I'm calling from the United Kingdom, and it's a hot, sunny day, which is very rare for us, but it's always very welcome. I've been in finance for 25 years. The first 17 were at HSBC Asset Management in London, and I managed a $3 billion multi-asset book. And I got the Bitcoin bug in 2013 and set up ByteTree. And we do a few things at ByteTree, but perhaps we can come on to that later. But essentially, I just came across gold in 1999, a presentation by Tocqueville, and I got the bug. And I've been talking about it, writing about it, investing in it for 25 plus years. 25 years. And so that's really my connection. And I suppose the thing that's notable that I've done recently is put Bitcoin together with gold into an index. We could talk about that too.
Okay, so you talk about doing asset allocation for a $3 billion book of business. I'm going to assume that gold and Bitcoin were obviously not a big part to that, but talk about just how asset allocation in your view has changed from running a large book of business to where we are in the cycle now.
Certainly since the sort of my heyday when I was running the big money, I think that the role of active managers has shrunk massively, and people have run straight to ETFs and tried to put the global allocation together that way. It's a very efficient way of doing so there's no great surprise, and it's been cost effective. I think that alternative assets have gone out of fashion, which is surprising given the talk about inflation these days. And, alternative assets would include commodities and all sorts of other hard assets you'd expect to withstand periods of inflation. Surprisingly low allocations around the world to these sorts of things. And I suppose, people think the 60-40 is somewhat broken because the market's so dysfunctional in so many areas. We've got the concentration of the top 10 tech stocks in the stock market, and then we've got the inverted yield curve, and we've got the fact that credit seems to be poor value relative to government bonds. There are so many things that make little sense in markets compared to how we're used to. So, these are tricky times. There's no obvious safe haven. And I think that, the final thing I'd say is back in 2000, when I was running multi-asset money, it wasn't difficult. We had to do is be diversified. If you owned high yield bonds, real estate, equities, commodities, CTA, stuff like that, you sailed through that bear market. It was only tech that went down, really, and Enron. And then in the credit crisis, government bonds provided a safe haven, as did the yen, the Swiss franc, the US dollar. But this time, what does a safe haven look like? It's getting harder to define. The market seems to think it's NVIDIA.
I love that. We'll definitely tease that out. But it is interesting. I think a lot of this, though, you can argue has to do with just automatic flows in large cap equity funds. A lot of people claim to want to be active and consider alternatives. But, you and I both know that when it actually comes time to pull the trigger, they tend to not do so. What do you think it would take to cause some real money movement in the space? I mean, last year really wasn't it because, the truth is, unless the alternative side was really playing with anything that was tied to a surging dollar, a lot of other alternatives really didn't do all that well. Commodities did well in the first 6 months, but then kind of meandered after that. Energy stocks did quite well, but that's not really alternative. What do you think it'll take to get sort of a broad asset allocation shift?
I think shock, some sort of shock to the economy to make people, wake up and change their allocations. I think that, we've seen the sort of value to growth shift. It really didn't last long, but that's highly correlated with the inflation cycle. And, right now, gold is telling you, if you believe the gold price is correct, then gold is telling you that the long-term inflation target is more like 3.5%. And if you believe tips, then it's telling you it's more like 2.2%. One of them's right and one of them's wrong. And what's interesting about this is, the last 2 decades, they've had the same answer. There's been very little deviation from the message. And I think that people, what do I mean by people? I mean markets. And markets sometimes aren't people, aren't they? Because you just get these big lazy allocations like, inflows from the pension saving industry and this kind of thing. And these distortions come along, as you rightly say. And if you go back to the 1999 to 2000, there was, stocks like Nokia were 80% of the Finland market. I think it was the same in Canada with Telenor. No, that's Norway, isn't it? Whatever that big telecom company was in Canada. And then, of course, the big tech. And then in my country, UK, we had Vodafone that was 15% of our market. So we have seen in the past these extraordinary concentrations of a few stocks in markets. And of course, Vodafone is down, 90% over the last 20 years since that time. And all of those companies that dominated the indices, none of them worked out too well. So, I think mean reversion was ever thus. Give it time.
Given your period, are there signs for the timing of when that mean reversion takes place? So I've made this point before that we've never had a juncture in history where the S&P had so much idiosyncratic risk. Top 5 stocks make up like 24, 25% of the index, which is at an all-time high. So yeah, a supposedly diversified index now is really being driven by 5 stocks, which means there's company-specific risk. But from those examples of Vodafone and others in the past, what was the trigger to break that dominance? Because the reality is narrative always follows price, right? So price has to move, but what causes price to move?
Well, the mobile phone, or a cell phone, I think as you call it, there was promises that we'd all have 10 each and pricing power would stay there forever. The same with broadband. I don't know if you remember, but in the late 90s, there was this idea that they would run out of pipe capacity for the internet to go around the world in fiber optics, and price of fiber bandwidth, or whatever you call it, went through the roof. And then it completely crashed because they built enough, it turned out, for the next 100 years. And, it's strange how these things change. And I suppose Vodafone collapsed because earnings collapsed. Simple as that. So what would knock Microsoft and Apple and those guys off their pedestals? That's the question. Something will one day, because it always does. And whether it's cheap competition, and it must be getting harder and harder for these companies. I'm no expert in these companies, not claiming to be, but one day someone will challenge Microsoft software and someone will challenge the Apple phone more effectively than they have done in the past. And we have 3 spreadsheets on Google, but they're not very good, are they? Let's face it. I mean, I'm addicted to Microsoft software and I'm addicted to my Apple phone. But one day that might no longer be true.
Right. And I think that's what's being said. There's a tremendous amount of recency bias, and history would show that recency bias is often when not only do you have the strongest manias and momentum, but also the strongest crashes, right? Just a question of timing. So, okay, let's go to Bitcoin. You mentioned you got the bug in 2013. What turned you on to Bitcoin in particular back then? Because Bitcoin, as I recall, was actually having a pretty good year. I think I had written a piece for MarketWatch at the time saying, why don't you compare, your performance against Bitcoin? Because everyone was doing that at the time. And, it's like, that's not the right benchmark for most people anyway with their portfolios. But what is it that turned you on to Bitcoin back then?
I was fascinated. I've always enjoyed tech and computing and that sort of thing. And I'm no expert in it, but I've always enjoyed it. And I've enjoyed, mankind driving forward and that sort of thing. And I've enjoyed money and I've enjoyed gold. And I just sort of got the arguments. And I remember being totally dismissive of Bitcoin in 2012, saying, don't be stupid, when a friend of mine told me about it. And then in 2013, I came back and I watched the $100 breakout. I didn't own any, unfortunately. But I watched the $100 breakout and I was just mesmerized. And at that time, you couldn't open an account anywhere. I think there were just bottlenecks right across the board. And there was a big spread between Mt. Gox, Bitcoin, and every other Bitcoin because you couldn't get your money out. And all these sorts of things. There's always been some scary crisis in Bitcoin, but it's always innovated itself out. And I just like the narrative. And I sort of studied Litecoin and the other things, and soon realized there can only be one. It's a network effect situation. A bit like the number 2 Twitter. It's not worth bothering with. I mean, you only need one Twitter, you only need one Facebook, you only need one. Of all of these network type situations. So that's why Bitcoin is so dominant. And I just sort of got it. And I sort of realized that the self-correcting mechanism, the lack of a CEO, the fact that the whole thing's open source, it's not hiding anything. And I thought it was an inspirational piece of innovation. So I got very excited by it and studied it. And my first prediction, by the way, guys, I think I wrote about it the first time in November 2013. And I predicted a crash of 80%. And I turned out to be right, which is probably 50% luck. But then later in 2015, it was very obvious. Moving averages were turning up. And we'd done some work in the background. Bytree had dug into the blockchain, downloaded a node, and done some financial analysis. And we realized the network was growing again. The price was starting to ascend again. And so I was screaming. I was banging the table at $250 in 2015. And that worked out pretty well. And, I don't know how much you want to talk about Bitcoin, but I can bore people with it quite a lot. But I just think it's fascinating. I think it's very different from the rest of crypto. I think that it's inspired central bank digital currencies, which is probably a bad thing. I think the future of financial markets will use technology that resembles crypto. We'll leave whatever we're doing today behind. I think there are many changes, and it's going to take us into exciting new areas.
Okay, now, and I'm with you on all that, and I don't disagree with any of that, but it's always been fascinating to me that the narrative has been it's Bitcoin versus gold. And the reality is the price movement of the two tend to be very different. I'd argue that they attract very different demographics. Right? Gold skews older, Bitcoin younger. Let's talk about sort of the framing of the tug of war in terms of getting investor attention between gold and Bitcoin. Gold's gone nowhere for over a decade, Bitcoin obviously has been all of the movement and attention. Do you think there's going to be a flip in which outperforms which? That, maybe we start to see gold actually outperform Bitcoin while both go up, or is Bitcoin still going to grab most investor attention?
So let's unpack that. You've asked some really good questions, but you've actually asked even more questions than you might even realize. And, because when you said that gold hasn't done anything in the last decade, that's in US dollars, which have been really strong. So in most currencies, it's actually done a pretty respectable job. But in the prior 10 years, gold roofed it. I mean, gold is still ahead of the S&P 500 this century over the last 23 years, including dividends. And that really is something that most people don't understand or aren't aware of. Gold has been spectacularly strong this century. And for good reason. Bitcoin's come along. It's the new kid. The high performance is really a function of the fact that it came to market at such a low price. The first Bitcoins were trading at sort of, we're talking less than a cent. And so if you had an IPO at $150,000 market cap or something like that, it's not surprising that if you become a multi-billion-dollar asset, then your returns are so high. So I think that it's not that Bitcoin went up so much. It just came to market at de facto zero, which never happens in investment, right? No company IPOs with a number that small.
But I'm glad you mentioned that, because I think that's a point that's missed by a lot of people that will show a chart of how well Bitcoin is done. It's because your baseline was pretty much at zero, right?
Yeah, well, exactly. So the first $10 billion, I mean, nothing comes to market less than $1 billion or 10 these days, is it? That's any good. It's a big tech thing. And so, the first billion was on the house, as it were. I think at one time, I've forgotten how many doubles there are. I think Bitcoin's doubled 19 times. Now, the story about the Egyptian king and the rice on the chessboard. I mean, to double that many times is pretty impressive. It's more than anything else has in the stock market, Microsoft or what have you, over the years. And, to talk about Bitcoins in doubles, how many doubles has it got left? I think that's probably quite a fun thing. I think it's probably got 3 or 4, possibly 5. But then, as the behavior, I mean, I don't know if you remember the other day, Bitcoin's trading around 26K. And the other day it had a bit of a drop. Was it Monday? I think so. Who cares? Anyway, but that day gold went up. And we keep on seeing this. We keep on seeing gold having an up day when Bitcoin has a big down day, or vice versa. Bitcoin roofs it, goes up 20 to 10% in a day. In fact, 10% days are getting rarer. We're now generally in single digits because the structural volatility of Bitcoin keeps on falling. But, the price of Bitcoin might go up quite a lot one day, and you'll probably see gold down. And I would say that the evidence suggests that most of the time, Bitcoin has low correlation to gold or negative correlation to gold. Now, that is not true when the dollar is falling or the dollar is rising. When the dollar is moving aggressively in one direction or the other, both assets tend to become more correlated simply because of the denominator effect. So I think that, if you strip the dollar out of the equation, that I would say that Bitcoin and gold have natural low or negative correlation, which means it's not Bitcoin or gold, it's Bitcoin and gold. They're a portfolio in their own right. As you well know, bonds and equities, we're brought up to think they're uncorrelated, although, been correlated in recent times, the recent last couple of years. And that's probably because we're going to a high rate environment. The jury's out whether it's whether inflation's there or not. But if rates sort of structurally stay high, the evidence from history is that makes equities and bonds more correlated, not less correlated. And it's only if we go back to a disinflationary environment that can reverse. And I would argue that just as equities and bonds make a portfolio, so do Bitcoin and gold. And I think that to say one's better than the other is completely miss the point. They're different, Bitcoin's better for its portability and that sort of thing. But gold's got a much more impressive shareholder register. I mean, it's got the world central banks for a start.
Now, the question, of course, is that since you mentioned 60-40, I mean, you wouldn't do 60-40 as an equivalent of, gold, Bitcoin, because the volatility of Bitcoin is very different, right, than gold. It's certainly relative to stocks and bonds. It's a totally different stratosphere. So, and you've probably seen the same studies I've seen, that there's a tremendous value to the idea of rebalancing even on a monthly basis, right? If you have an allocation in Bitcoin to effectively reduce as it's rising and add as it's falling. How do you think about the relative weighting composition of gold and Bitcoin, given the drawdown dynamics of the two?
Yeah. So the Budgie-Bold Index, which does this, and it uses inverse volatility. And so that basically means the more volatile asset gets less. Now, volatility is volatile. So we use 360-day volatility, which is quite unusual. Most people would talk about volatility to being 30 days or 90 days, possibly 180 days. But those are very much the timeframes that most people would refer to. The reason I don't use those short-term things is I think they've got some kind of information bias in them. What I mean by that is, all assets go through periods of volatility, then they calm down and they get into a tight range and they break out and the volatility picks up again. It's a normal part of a security cycle, but there's no alpha in that information, because that's non-directional. So, if you have low volatility, if a stock is normally 30% volatility and it's going through a 20% patch, that's not telling you it's bullish or bearish. It's just telling you it's consolidating. And thereafter, there will be a break one way or the other. Because we've been in a bull market the last 10 years, it's probably up, but it doesn't mean it's always up. It could equally be down. So because there's no information in that number, directional information, I wanted to have a time frame big enough to cut through all that. And 360 days sounded about right, because the whole year, within a year, you've seen volatility rise and fall several times. So what you're now doing is capturing the structural quality, the asset quality. If you say that high quality assets have low volatility and volatile assets have lower quality, then you really are assessing that. And what we find is that Bitcoin's 360-day volatility is about 45%, having been 150 10 years ago. So this thing, if Bitcoin's growing up, and gold's about 15 over a 12-month period. So every month, the Bitcoin prints a lower 360-day volatility. The weight goes up a bit. Currently, the index will have you about 22 Bitcoin, 78 gold. And that rebalancing, as you rightly say, is fabulous because these assets have low or negative correlation. Rebalancing makes a lot of sense because you're adding a little bit of value every time you do it, to the tune of about 5 to 7% per year on average. Now, if you took correlated assets like gold and silver or French and German equities, there's very little point. You're going to have very little benefit. In fact, you might even destroy value because you might be selling the outperformer at the wrong time. So, having this sort of bond equity rebalancing approach or Bitcoin gold, to my mind, is a really good way for adding value and also maintaining risk.
What would it take to get gold volatility to rise on that time frame? So I get it. It's obviously two very different sizes of markets, right? So that's going to be also a big driver of volatility dynamics. But yeah, presumably at some point, if gold breaks out, which I myself believe it's likely to happen this year, then gold could get a lot more violent on the upside.
Yeah. So 1979, 80, I was a kid, by the way. I'm not that old. The volatility of gold went through the roof. Gold in that year looked like Bitcoin in 2017. I mean, okay, it didn't go up 100 times or whatever, but it kind of went up. It doubled or something. And this is a major world monetary asset held by the central bank. This is not an altcoin. And so if you look at the chart of gold in the late 70s, yeah, Bitcoin, gold volatility went right up. And of course, in that situation, you'd be glad. Okay, Bitcoin wasn't around back then, but had you had some rebalancing portfolio, maybe or gold and oil or something, back in the late 70s, that signal on the gold volatility would have said, do you know what, we should have less of this. And it would have been right, because the next 20 years in the 80s and 90s, gold was, no use to anyone. Price just kept going down.
Okay, so let's talk about other differences between the two. Again, I mentioned demographics seems to be a major one, right, in terms of which asset attracts the other. From a standalone perspective, did you ever buy the argument that Bitcoin is, in quotes, digital gold? I mean, that was a narrative that was out there, was done on a lot of advertisements, but I always thought that to be a little bit silly because you wouldn't want it to be digital gold. You wouldn't want it to be like gold because if it's like gold, it means it's not going to move. Yeah, at least the last decade, right? I mean, the irony of this stuff.
Yeah, so you could say it's going to be digital gold. That's fair. We're on the journey to becoming digital gold, and in which case, in 10 years' time, we'll get there, and the volatility will fall. But like I've just said, it is falling. So as it falls, it's trying to become digital gold, which means Bitcoin gets less interesting. But that's fine. Because we're now dealing with hundreds of billions of dollars, market cap 500 billion or something. I'm sorry, I've completely forgotten. I used to follow that number, but I don't bother anymore. But, so that's going to go up, but it can't go to 100 trillion, can it? Or whatever. It can't really pass gold at 13 trillion. So, there's 10 or 15x in Bitcoin on that basis, which is fine. And it's more liquid asset. And I think it's more suitable for mainstream asset management these days. You would be much more comfortable as a professional investor putting money into Bitcoin than you would do into Solana or Cardano. You know what I mean? So because it's grown up and it's a serious part of the macro framework these days. The regulators don't think so. The institutional investment industry do not think so because they sort of banned it or not engage with it or whatever. But they are wrong. They're on the wrong side of history. Just as you're on the wrong side of history by not owning gold in the early 70s. And they didn't. So there are times when the private investor can be leaps and bounds ahead of institutional investors. Actually, it happens more frequent than you think.
Do you get a sense that institutional demand has slowed down? I mean, there was a lot of excitement and talk around investing in Bitcoin as an allocation. Obviously, a number of products came out. The Bitcoin futures ETF, I think largely marked the kind of short-term top with it. I say short-term because we don't know, right? But it has the drawdown that happened caused some institutional investors to shy away from it.
Yeah. So the peak. So if you define institutional investors in Bitcoin as Grayscale, GBTC, and the ETFs in Canada, Brazil, and Europe, you've basically had no inflows for 2 years. And gold's not dissimilar. I find it fascinating in this world of uncertainty that there's been such low demand for alternative assets. And gold and Bitcoin are the two most liquid alternative assets in the world. And really, investors are not buying them. Because I think that, these sort of pre-2008 maverick fund managers like me kind of left the industry and to do their own thing. And the industry's become very passive and very stale and very 60-40 and regulatory driven and this sort of thing. And the result of that is that there aren't many people arguing the case for alternative assets, mainly for career risk. And, if they're not buying gold, I think Dan Tapiero made this point. If the global wealth management industry isn't buying gold, which it really isn't, according to the flows that we track, then it's definitely not buying Bitcoin, because that's a much harder argument to win. You're trying to put in a 45% volatility asset compared to a 15. And at least gold, your central bank, the Federal Reserve own gold, the Bank of England own gold. So you've got an argument, you can defend it. That, but no one owns Bitcoin in those circles. None of the sensible establishment own Bitcoin. So there's no one to point to and say, oh, they own it, so therefore we can. You are seen as a maverick, and that is a problem when you're dealing with other people's money. So that's why I think that it hasn't happened. But what we've learned from history is that there were massive inflows into these ETFs and Grayscale back in 2017 when the price of Bitcoin was going up sharply. And then they came back again in late 2020 and 21. And so I just think that after halving next April, we're just going to have another price surge, and it will just shake the institutions, and they'll see the price go up and they'll just start buying. So I think they will come, but we've just got to be patient. And we all know, the stock market and so forth, it's not exactly in a good place. I mean, we talked about the divergence with the concentration, but the new economy, which can escape reality, it doesn't have to suffer these real world issues like debt and recessions. I mean, big tech doesn't have any debt, right? Or net debt. So it doesn't care about the bond market. And it doesn't live in the real world. It lives in cyberspace. So we don't have to worry about things like war and inflation. And so there's a sort of narrative that just takes it off. And that's all very exciting. And then the rest of the world can, go hang. But the bottom line is that the long-term themes in investment, demand for commodities and these things will become reality again at some point. And then the people will eventually get bored of NVIDIA and Apple, and, we'll have the shape that's overdue. There's so many pieces of evidence. The relationship between bonds and equities is as stretched as it was in 2000. And, then most of them are obvious, talked about by Twitter all the time. We know about the imbalances in the world, and they will come to head at some point.
I love that point, by the way, about just, it's almost like you need to have a PR move just to get people to, institutes to be allocating to gold in order to be the first step to really get them to allocate to Bitcoin. I think that's actually a very underappreciated aspect of how do you convince bigger money. You've got to get them to be convinced of alternatives, period. Right? Gold is the easier first step to that than Bitcoin.
Exactly. I mean, Michael, that's exactly why I invented the Bold Index. Because when I was sitting at HSBC in 2013, I discovered Bitcoin. I was very excited. I was planning my departure from that firm. And we'd had the Mexican drug scandal. It was a horrible place to work at that time. And I was thinking to myself, how would I allocate to Bitcoin? How would I all I wanted is 2% Bitcoin. I'm not asking to put the whole portfolio in. I want 2%. And it wasn't obvious to me that to mix it with gold was the answer. But a few years later, when I started, having observed this sort of behavior, I mean, don't forget, in 2013, gold collapsed, right, by a third. And in 2013, Bitcoin went up, 50 times or something. And it kept on happening. 2017 was a great year for Bitcoin and a terrible year for gold. And vice versa. The COVID March crash, gold didn't go down very much at all. Bitcoin went down by 50% in days. See, and then they reversed, by Q4, the second half of 2020, it reversed. Bitcoin goes up, I don't know, 4 times, something like that. 3 times. And then gold starts falling. We just, keeps on happening. And it was when I realized this behavior was so consistent is when I created the bold index. Now, if you put Bitcoin and gold together on the risk adjusted basis, your volatility comes down to literally 1 point over gold. So if you're happy to buy gold, then you can buy bold. And if you can buy bold, then, and it's less volatile than the stock market most of the time, then that's great. And this is the easiest way to introduce Bitcoin to institutional investors. So I built bold, not for, people listening, but for institutions. How would you engage the world's two most liquid alternative assets in the right weightings, or approximately the right weightings most of the time, in a package? So if I think you manage other people's money, if I'm right. Do you want to have a conversation with your client saying your Bitcoin's down 50% or it's up 10 times? So that's nice, 10 times up, but it is down 50%. And no, you don't want to have that conversation. But if you mix it with gold, then your conversation is, over the last 6 months, our gold's up 5% or up 10% or down 5% or down 10%. You don't, you can then talk about other things. You can talk about bonds and equities and whatever. It's a very simple way of putting together the world's two most liquid alternative assets into a neat little package, which delivers alpha because of rebalancing.
And that's based on spot Bitcoin or Bitcoin futures?
The index is based on spot Bitcoin. Yes.
Right. And I believe you have an ETF, right? That probably is on, I assume, on the futures doc.
Yeah. So the ETF's in Switzerland. I don't have one. 21 shares have one that track my index, the Bitree Bold Index. And it's in Switzerland because these ETFs they're disallowed in my country. So our regulator has banned any crypto at all in ETFs. In Europe and Switzerland, they're legal. They're legal in Singapore, Hong Kong, Australia, Canada, Brazil. But they're not legal in the United States, and they're not legal in the United Kingdom. So I guess we live in the wrong place for to be buying Bitcoin over the stock market.
To reset the room for everybody's here, please make sure you follow Charlie Morris here on Twitter. If any of you want to come up and ask questions, click that bottom left mic request button. And as always, this will be under Lead Lag Live on all of your favorite platforms, Spotify, Apple, so on and so forth. So I think that's a good transition to talk about regulation. And there's been a lot of interesting dynamics when it comes to what we've seen recently with the SEC going after Coinbase and several other types of firms. Looks like they want to finally get into this discussion around, is it a security or not, the crypto assets that are out there. Where are we in your view on progress when it comes to the regulatory framework? It's got to come primarily from the U.S. first, I would think. But, let's talk about the U.S. and then also what you're seeing internationally.
Look, this is my weak area, regulation. I find it A, very boring, and B, I don't know much about it. But I will say that Bitcoin is neutral and they can't stop it, and it's global. And I think there is a feeling in financial markets that everything needs to be American. But I think in this case, and that's true in most things, it's true in bonds, most bonds are American, most equities are American, certainly by value. But Bitcoin's really no one's. It's out there. It's a bit like oxygen. You can't claim the oxygen. You can't claim the Bitcoin. It's a neutral technology that's global and has a bridge between the continents, even if they disagree politically. So I think that's fascinating. And the regulator, they can cause lots of harm. And I think that, he has got a point that a lot of people were trying to bypass SEC rules and create businesses effectively by using crypto tokens, which end up pretending they're not securities. But I don't want to get into the legal because I don't understand it. And as I said, I don't really care. But what I do care about is the legitimate growth of this space, because that's the exciting bit. That's what's going to bring in institutional investors. So this is a cleansing process by which we can have a framework to move forward. Then that's a positive. And the Swiss did it several years ago. That's what my product's in Switzerland. It's a place where they welcome you rather than, ask you to move along. And I think it's great that the US is going to go through this process of pain and then come out the other side, hopefully with the answers. The sooner we get there, the better. So that's not a bad thing. And there's no way the space is going away. I mean, if you read the grown-up newspapers like the Financial Times or the Wall Street Journal or something, and the comments that people write in Bitcoin, there are so many people out there, generally over 40 probably, who just don't get it. They do not understand that these are large electronic, sustainable, high usage networks. And there's so many other benefits to this thing. And, we do some research on various crypto projects, less me, but guys from my team. And I'm never, ever disappointed by the ongoing, relentless innovation, what people are trying to achieve, get themselves into AI using identification systems or, file sharing or internet Wi-Fi usage. It just goes on and on. People trying to solve problems in new ways that that computers can communicate with one another. How can that be anything other than positive? If Bitcoin was going to be dead, it'd be dead by now. It's been through these savage bear markets, 3 of them now in the last 10 years, and it's still here. So the regulator, I think most of the bad news is in the rearview mirror because it's been so vocal and everyone knows about it. I think it's going to be awful for some of the crypto stocks, probably. But I don't think it's going to impact Bitcoin very much at all.
What would you put the odds of there being a lost decade for Bitcoin? Nobody ever thought that gold would have a lost decade when it peaked, and then it did. Same, I'd argue, with emerging markets. I mean, that's the thing about lost decades. You don't know until you're in the 9th year, right, Dave, if you're in a lost decade or not. But I get the adoption. I get all the user growth. But is there a chance that it just kind of goes nowhere like other parts of the marketplace?
Quite possibly. But I think that's true for most asset classes, isn't it? I mean, I think you could say that about global equities. It's not just Nvidia and Apple that are highly priced. It's also McDonald's. All of these things, Nestle, Unilever, all of these companies just don't offer the cheapness they once did. And in a higher interest rate world, it's just the whole thing puzzling. I think I posted a chart the other day showing the yield on HYG. It's approximately the same as on Fed funds. I mean, Fed funds are only a tiny bit below high yield bonds. How that doesn't make any sense?
It's completely insane. I mean, on so many levels.
It's madness. And we all know that, but there's something else is going on that we don't really understand. But ultimately, when we say the market thinks, the market never thinks. The market just goes to a level where buyers meet sellers. And for some reason, there are lots of buyers or no sellers, whatever it is. But there can't be no sellers because liquidity is not terrible. So there must be just lots and lots of buyers. So therefore, monetary conditions are still not tight, which is bizarre.
Well, yeah, and what's bizarre against, a stronger dollar than it was a year ago. Bizarre in the context of, the credit contraction from the regional bank side. It's bizarre in the context of higher rates. I mean, either it's that there was so much liquidity that was printed that they're still underreacting to how much they printed, over the last decade, or we just are going to have a nasty delayed response.
Yeah, I think nasty delayed response is how it normally works. I was reminded, I did a chart because I write a thing called the multi-asset investor every week. And it's not a Bitcoin piece, and it doesn't talk about gold much either, actually. It just talks about the mainstream stuff. And it's one of those situations where everyone tells you an inverted yield curve, where long-term yields are much lower than short-term yields. And that's, we had the biggest inverted curve for a long time. And everyone will say, oh, that forecasts a recession. That means everyone's going to safety. Okay, fine. But then the stock market doesn't go down until the Fed panics. And so the last 2 examples of whether it's 2008 or 2000, end of 2000, 2001, on both occasions, it wasn't until the interest rates started coming down that the stock market started tanking. And so it's almost like we know we haven't got tight conditions because if we did, then asset prices wouldn't be behaving as they are, right? So they're not tight enough yet. And whatever inflation is doing, that must be true. And it's not. We shouldn't really panic until the Fed panic. So at the moment, they're more worried about fighting inflation, and no one's lost their job. But then we're reminded by other things like Zoltan Polzar, who says that the labor market is tight because of demographics. There are too many old people, and there are more old people, so there aren't enough workers. So we're not going to get the big unemployment that we expected in normal recessions because there aren't enough workers in the first place.
But then, of course, you and I both know then the AI narrative kicks in and says, yeah, but you don't need to have enough workers. AI is going to make you that job, right?
Yeah. So the AI narrative is fine if they deliver profits and those stocks can do what they like. But if they don't deliver profits very quickly, and then the narrative would only be worthwhile until the system's too tight and it breaks. But the narrative can continue until that time.
Well, how does other dynamics when it comes to technology play into demand for Bitcoin? You kind of alluded to before that money flow, right now it's obviously going to AI. It's not going to, blockchain companies or anything on the miner side to the same extent. But do you think there's some validity to the idea that Bitcoin is viewed as part of the technology sector that it now has to compete against new technologies? Yes,
that's a good question because, I read a piece recently called, what is it called? Clever and lazy people win, right? And this does not mean, clever people sitting in an armchair having great thoughts is going to lead to success. A clever and lazy person is someone like Elon Musk who looks at a car and says, my God, that looks like too much hard work to make one of those. How can I make one more easily? How can I do it faster? How can I do it cheaper? How can I get rid of half the parts? So clever and lazy people are not idle intellectuals. They are highly dynamic people who want to massively increase productivity. And so being told you're clever and lazy is the highest compliment there is. And Bitcoin basically is the clever and lazy man's tech trade. Because if you look at it, it's highly correlated with the NASDAQ and these sorts of themes, cloud computing and all that. And yet it seems to continuously outperform, every single cycle. Okay, admittedly, the NASDAQ's been doing better than Bitcoin the last few weeks, but this year, I think you could safely say that Bitcoin's still way ahead of the NASDAQ. And the same is true with gold and commodities. Commodities underperformed gold by about 1.2% per year for the last 30 years because of human ingenuity, more productivity in getting metals and oil out of the ground and farming. As a result of that, gold is the one that doesn't have to suffer from productivity. It's the one that stays up there and therefore outperforms. And there isn't a single metal or energy or anything that's done better than gold over any reasonable time frame. It's miles ahead of the sector. And so this whole idea of Bitcoin just being the tech trade, does it have to be relevant? Well, Bitcoin doesn't need to change, but the applications that people build around it can change to make them relevant. But I think that provided Bitcoin remains a big, robust monetary network with lots and lots of volume, liquidity, and so forth, then the innovation will just follow. And the reason why Litecoin is not Bitcoin is because the developers are not there, and therefore the liquidity is not there. And the liquidity is not there because the developers are not there. It's network effect. So it all comes back to that. So I think that if Bitcoin can remain this sort of useful financial tool, which can turn electricity into money and send it anywhere immediately, then why can't it be a useful way of playing the tech sector? As I said, I think there are two ways to sell Bitcoin to the institutional investor. One is to go through the gold route. So if they like gold, therefore one more step, have some Bitcoin, ideally via the bold index, because that solves another problem and gives you some alpha. And the other way to sell Bitcoin to the world's institution is to go down the tech channel. If you find people who like tech and you say, well, this is how the world financial system will work. I'm not suggesting that Bitcoin becomes the reserve currency. I'm just saying the space that's being built is the basis for the future financial system. And you get people interested in that, in the space that way. And so, yeah, absolutely. Bitcoin is plugged into the tech world in a way gold really isn't.
Okay. And then the final question on my end, again, anybody wants to chime in, feel free. There's always the argument that you want to play the manufacturers of the picks and axes, not the actual commodity itself, right? I mean, there's always that argument that that's sort of the real investment play. What do you think about the idea of just, going purely to the Bitcoin miners? It's like, if you're going to allocate capital, just do the miners as opposed to Bitcoin itself.
Do you know the joke about Bitcoin? And this includes the business that I built. No one on this planet has built a business that's outperformed Bitcoin. So any clever trick to try and outwit Bitcoin has ended in lesser performance. Now, maybe Bitcoin's mature enough now that that's no longer true, and you can do it better. But mining has been a highly cyclical industry, highly cyclical. You got to go and buy all these chips off NVIDIA. That's NVIDIA again. And then you got to go and find all this energy. Hopefully it's nice and green because people like that. But you've got to do those two things. And then you've got to hope that the price does the right thing. So there's a risk of going to zero. With Bitcoin, there really isn't. Unless the network dies, and I suppose there's a 1 in a million chance that happens for some misunderstood tech reason or supercomputer or something. But also there is a small risk that people just get bored of Bitcoin and they go and do something else instead. So that's, I think that by trying to outperform Bitcoin by shovel providing, whether it's Coinbase type investment or mining, you really are taking on materially more risk. And let's face it, crypto has enough risk without that. So I would just stick with it. I think the clever and lazy thing to do is just to own Bitcoin.
For those that want to be more tactical and active, aside from, look at the bold index for allocations, are there other trading strategies or indicators or things that you've seen that seem to help determine when to allocate more towards Bitcoin and gold? Take out the sort of longer term volatility dynamic, more shorter term dynamics. Anything that's been interesting to you that you track that might make you want to overweight or underweight, tactically?
There are a few things. I think if the dollar's falling, that's better than if the dollar's rising. You want bond yields to be rising rather than falling because of risk on. Inflation expectations rising better than falling. Basically, Bitcoin's correlated with commodities and heavy industry more so than it is with tech. It may not appear that way because it does seem to have some sort of resemblance with the tech cycle, but it does like a sort of overheating economy. Bitcoin does best when the economy is overheating. And so it's really firing up, where gold does best when the economy is stone cold. So that there is a difference there. So there's a few external macro things. From the on-chain data, I like things to be stable. I'd like the difficulty adjustments to be modest. I would want to see fees to be rising slowly, not quickly. I would like to see the transaction value, which I think is the most important indicator of all, to be steadily rising. So more and more traffic is going across the blockchain on a weekly, monthly, quarterly basis. Those sorts of things. If you've got all those factors on your side, then there's no stopping Bitcoin. Weak dollar economy and a strong blockchain. That's a powerful combination.
For those in the audience that listen to the podcast, how do people read more of your research and talk about ByteTree and sort of the impetus of everything you're doing and why you're doing it?
So ByteTree.com, that's Byte, B-Y-T-E. And most people don't know what a byte is for some reason. I mean, I was brought up in a world where the computers were bits and bytes, maybe because it's gigabytes and terabytes and all that nowadays. Then no one really knows that a byte is 8 bits. And so ByteTree it's a sort of comical name. It's a money tree. And so when I wanted to build something around Bitcoin, I called it ByteTree. And frankly, we've done very well in some areas and we've done very badly in other areas. And where we've done really badly has been the original mission, which is to sort of, to provide data in Bitcoin. And we've got lots of data, but we've put it on the back. We put it on the back foot. And now we've refocused in the last few years on asset management, hence the bold index and research. So I've gone back to my old life of doing traditional portfolios like I did when I was in banking. And, we've got a large retail following. It's mainly British because I talk about global investment, multi-asset investment from a UK standpoint. And we do have international investors as well, but it's very much a UK-based conversation. So that's probably why it's not very well known outside of the UK. And we do a bit of crypto research and we host some other research. And then we've got this thing called Byte Trend as well, which is quite fun. So if you like trend following and identifying where ETFs are going and where the trends are, then that's also on our website. So ByteTree.com, feel free. There's a free sign up thing. And I write something once a week and, you can learn more by going through that process and have a hunt around. But it's, we love what we're doing and our clients love us, but we are a boutique.
It's a good place to wrap this Twitter space up. Again, everybody, please make sure you follow Charlie Morris here on Twitter. Appreciate it, Charlie. You're very knowledgeable. I think you make a very compelling case for blending the two, gold and Bitcoin, together.
Michael, thank you. It's been really good fun.